For decades, the path was simple: study, get a job, settle down. Now, your feet tells you to do this: study, work, invest, retire early, and live off your investments. It sounds great on paper, but can the average person really achieve this? Or are Finfluencers selling a pipe dream? Let me show you what it really takes. I am Abhirami Sekar, and on behalf of the Federal, I wish you all a very happy Independence Day. We have achieved freedom as a nation. But there is another kind of freedom a lot of Gen Z are quietly obsessed with. It's financial freedom. So, is this actually happening, or is it just something that looks good on a reel? Turns out the intent is real, and the numbers back it up. According to NSE's own Market Pulse data, Gen Z's share of India's registered investors has jumped from under 24% in March 2020 to over 38% by May this year. Even more telling, the median age of a new investor has dropped from 29 to just 27. This isn't a small shift. Nearly 59% of new investors entering the market this year are under 30. Whatever is driving this, it isn't just a talk. A lot of this comes down to how it's being sold. Finfluencers on Instagram and YouTube share tips on financial freedom through engaging content, catchy reels, and simple formulas with the promise that anyone can do this. And to be fair, they have done something useful. They have made investing less intimidating for a generation that grew up online. But the pitch often skips a crucial detail. Do you need to be earning big to pull this off, or can someone on a regular middle class income actually get that too? The math says it's not just for high earners. A simple SAP of 10,000 rupees a month started at 25 and growing at an assumed 12% return could become nearly 1.76 crore rupees by the time you turn 50. Wait, 10 years to start that same SIP at 35 and you are looking at roughly 69 lakh rupees instead, less than half. The difference isn't how much you earn, it's how early you start. That's the part that actually matters for a middle income earner, and it's usually the part that gets lost in a 30-second reel. I spoke to a young investor who didn't wait for a big salary to start. He began investing with just a stipend.
Starting, I was very defensive. Like I invested only in a PPF fund while I was doing my internship. After which I thought like a PPF account will give you only about 1.2 and it has a lock-in period of 15 years. Then I shifted my focus to direct stocks. And at initial stage, I invested many of the things by watching a YouTube video or Telegram. Then after which I did my research and started investing on my own by analyzing the P/E ratio and other stuff. So currently, my portfolio allocation will be half of which will be in a direct stocks and another 40% will be in mutual fund and some I have invested in gold and bond. At some point of time, I will be stopping my SIPs and investment for about 4 to 6 months. After which, when I join SRship, I might have a salary hike as well as a life standard update also. That time I might need a financial advisor because currently I'm investing low at the same time. My salary also considerably low when compared to others. So in future I might need a financial planner to analyze my portfolio and according to my risk standard they might allocate my money and do the stuff.
I also spoke to another Gen Z investor who is working out a yearly retirement plan.
When I got into a job, and this was something when I was 21, I think, right after, immediately after finishing college. My dad was the one who pointed me to just invest in RD, which is recurring deposit, and if I ever get early incentive or bonus amount, he would ask me to invest in FD, like a fixed deposit. Besides these two elements, I didn't have idea of anything that was out there, all those investment options. Basically lack of awareness. So so everything, like I was acting on my guidance of my dad. I wouldn't say it's a bad thing. I mean, he suggested whatever he knew. Okay, so when I started investing on my own, it was like after only 4 years. I mean, right after I started my job, right after 4 years. So during this time, I came to like I was having a random conversation with my brother, and I came to know that there are like options like stock, mutual fund, all those things out there in the market. So so I was like, yeah, basically I didn't have much of an awareness. So when I started investing, with the pay which I was getting back when I was 24, I was just investing 5% into mutual funds of my salary, and then another 2% or 3% in stocks. But I felt it was a bit risky, so I then started limiting everything to mutual funds only. There are several factors that can easily take my job away. So what I felt was, why should I wait till 60 or something for retirement? Just invest early, and maybe sometime if my job, if there is no job security at all, then I figured that early retirement would be a better option. So I started investing early.
That's the intent, real discipline, starting small. But intent alone doesn't tell you if the plan actually works, especially in India, where the version of retire by 40 that goes viral online rarely accounts for the details that make or break it. So, we took this to two people who spend their time doing exactly that math, a financial planner and someone who tracks how India's finfluencer economy actually operates.
When we talk about retiring at 40 or retiring at 45 or retiring at a very young age, it misses out a very important point. So, because we are all focusing a lot on the income, but I think the expense side of it is also very important. So, say someone wants to retire by the age of 40 and they are going to live till say 80, 85. So, it means they have to save for the next 45 years. So, for that, they need to lead a very frugal lifestyle until they reach 40, and even post retirement, they will need to lead a very frugal lifestyle because even for a person who has a very minimal expenditure, say 30, 40,000, they will need a corpus of close to 2 CR. And to achieve that corpus alone, you need to invest at least 30,000 a month. And there is another aspect to it. A lot of talk has been done about you earn 12% return, 15% return, and there is a linear line graph showing that you start here and you retire by 40, you have this much corpus, and this is how it is achieved. But it does not actually account for the vagaries of the market because markets do not move in a single line. So there has to be some consideration, some thought given to the volatility in the markets. What if you end up you end up retiring in a recession year, so you need to plan for a lot of unknowns or unknown circumstances that might still arrive. Though mathematically speaking, if someone leads a very frugal lifestyle and intends to do so, then retiring at 40 or even 45 is possible.
Mathematically, yes, but it requires a lot more discipline than one may expect. Most people typically save 25 to 30% of their income, but FIRE requires you to save over 50% of your income every month. This is because we are trying to achieve financial independence in 15 to 20 years vis-a-vis the regular 30 to 40-year regular working life. Let's try to understand with a simple example. Suppose someone is between the 20 to 25 age band and earning about 50,000 per month. Now, if you invest 50%, which is 25,000 every month using a monthly SIP, and you compound it at 12%, and you increase the SIP by 10% every year, that can potentially build a corpus of about 5 crore over 20 years. Now, using the widely followed 4% safe withdrawal rate, this corpus should last you for your entire life. So, yes, the math works. But here's the catch. This assumes that the person can sustain a very high savings rate, increase their investments every year, and stay invested through different market cycles. Doing that consistently for 20 years without the right financial guidance, it can be quite challenging and it may not even be sustainable for many investors. And for a middle income earner, saving 50% of your income at 22 may be possible. But as your income grows, your responsibilities and aspirations grow too. So, retiring at 40 may be mathematically possible, but making the plan work in real life requires financial discipline, ability to adapt life as it changes, and the right professional guidance.
So, where does that leave Gen Z's retire by 40 dream? Somewhere between real and rushed. Finfluencers aren't the enemy here. They are often a good starting point, a way to make investing less intimidating and more accessible. But a reel isn't a financial plan. And the moment your goals get specific, retiring 15 to 20 years yearly, sustaining decades of expenses, accounting for inflation doesn't behave the way a calculator assumes. That's exactly the point where you need more than a creator's formula. Do your own research, but at the same point, sit down with an actual financial planner who can run your numbers, not someone else. Financial freedom isn't a myth, but it's not a template either. This Independence Day, maybe the real freedom worth chasing is the kind you have actually done the math for.